right, all right, guys, thanks for joining today. This webinar is going to be another episode of our series, How to Get Started as a Passive Investor. And I do this series every week, for investors. Maybe you have tried investing in passive real estate before, but got cold feet, or you actually invested in a deal and just realized, oh my gosh, I've totally made a mistake. Or you want to get started in passive investing, but you just feel so overwhelmed by all the information out there, you're not really sure where to start. If that's you, you're in the right place, so welcome. So what we're going to tackle today is learning one of the biggest myths that it keeps investors sidelined and never passively investing in syndications or funds. We're also going to learn what the preferred return is and why it's so important for you as a limited partner investor to understand the term preferred return, because I think there's a lot of in my conversations, day-to-day conversations with investors, there's a misconception of what the preferred return actually is. So we'll demystify that a little bit. And then we're going to actually get into some of how this impacts you and where you can find information about the preferred return and clue you in on a couple tricks to look at the PPM and questions to ask an operator before you invest. All right, guys, but let's go ahead and knock one of those biggest myths out of the way. We always talk about, one of the largest myths that keeps investors from investing passively is control. And we do a lot of education around like how you can actually gather information about the operator, the market, and the deal and put a huge amount of control in your pocket before you ever invest. But the other biggest lie that investors tell themselves is that I actually won't make that high of a return if I invest passively. So they never get started, okay? Maybe they don't even have their own active single family portfolio. Maybe they just never get started. Well, that simply isn't true. Okay, you see, we talked a lot about how passive investing helps us also leverage our return on our time, because you are investing in an operating business with a professional team that already has market contacts, a market team put together, has intimate knowledge about that market and the strategy they're investing in. They can secure all the lending, the credit, and raise other investor money in order for everybody to go in on that deal and benefit from that. Okay, so what we're going to talk about today about the preferred return is going to kind of fit into this, demystifying this big lie that some investors tell themselves. But before we get started, if you don't know me, I'm Whitney. I'm the Director of Investor Relations here at Goodegg, and this picture is the whole reason why I invest in real estate. Now, my family and I, we travel quite a bit. I need to update this picture. This was taken last December when we wintered in Sedona. We've taken several big trips since then in our camper. Fun fact, we will have spent a month in our little camper this summer alone. So, but all of that, still able to work remotely and live the lifestyle that we want. But this is the reason why we invest in real estate. I got started in 2002, living, flipping, and house hacking. And fast forward a few years, I did a few projects like that, and my husband joined me. But we realized all we had were buckets of equity. We had no way to change that into cash flow to unlock our golden handcuffs from our day-to-day job. And it was when we got into rental real estate that we realized we had finally landed on a solution to generate cash flow and appreciative gains, okay? And also take advantage of other ways that real estate pays you with tenant pay down, depreciation, and leverage, the ability to use leverage on an asset. When we figured out how to do that, we built a single family rental portfolio of about 30 units. We were doing about 6 flips a year on top of that, just to keep our capital buckets replenished. And then my husband, I decided I wanted to step away from my job, and my husband wanted that too. And was like, oh boy, we need 80 or more units. And I'm like, why don't we just go get a multifamily? We need a different way to scale. And that is what led us to partnering with Goodegg Investments. And fast forward about 2.5 years later, we've purchased over 27 multifamily properties. Okay, we've got our 28th one due to close here in just a matter of a week. We've also purchased 2 self-storage and a mobile home park on top of that. But we manage right now, currently, as of today, over 6,900 multifamily units and have an $850 million portfolio value. But what I get to do here on a day-to-day basis is work with you guys, the investor. And so we have a very strong investor pool for our deals. Now, just a quick recap. Like I said, this is one episode in a series of things that I do. So if you're looking for kind of the back history of the other episodes, or even just, taking, we have, well over 100 videos posted on our YouTube page. What are those first, like, say 5 or 10 videos you can watch and get a really good understanding of syndication investing? Well, guys, here you go. I am recording today's webinar. It will be posted as well, but take a screenshot of this screen, because when I send out that replay email, find these first videos, and that is going to get you the base primer on syndication investing, okay? All right. Now, let's talk about today's topic, okay? The preferred return, okay? We're going to define what it is, why it's important that you understand, and how it actually impacts your investment. Now, as always, the information that I go through during these webinars is for educational only, and we'll have a Q&A session. If we get into any legal, financial, or tax information, make sure you take this back to your team and you are understanding how this applies to your direct situation, okay? Very important here. All right, so let's define what a preferred return is, okay? See, many investors actually think that a preferred return is a monthly, quarterly, or monthly or quarterly, or maybe even annually guaranteed payment, okay? It's not. It's not an interest payment to the investor. So we've spent a considerable amount of time on the capital stack over the past 2 or 3 weeks, and the limited partner is on the equity side of the capital stack. So they're not debt, okay? If you want a guaranteed payment, you need to be on the debt side of the stack, okay? But when you go into syndication deal, there's an ability to be on the equity side and accelerate your returns, okay? But we're going to pick this apart a little bit more. I'm not going to leave you hanging, but if you don't understand what a capital stack is, we're going to go over it briefly today. But most investors need to understand how the capital stack works before they actually invest, okay? And how you're going to understand this is actually reading the offering memorandum and the private placement memorandum in tandem prior to investing, because that is where you're going to find the information that defines the capital stack, okay? So now I know I haven't given you a formal definition, but this is why it's so important for an investor to understand. Preferred return is not a guaranteed payment, okay? The preferred return merely states the order of how profits will be paid out on a deal, okay? It's not actually the return, okay? We just clarified the LP investors in equity position, they're not debt. The LP investors behind all expenses, fee, and the debt on the property. The preferred return is distributable cash flow, okay, i.e. profit, all right? So rather, it kind of, maybe a better way to put it is that the preferred return is not actually a return at all to the investor, rather a hurdle for the general partnership to clear in order to begin sharing profits with the limited partner, okay? So when we look at an offering memorandum and it says a preferred return is 7%, that means after all the expenses, fees, and debt have been paid, okay, and all the capital accounts are where the general partnership needs to keep them at in order to ensure the health and safety of that business, then X% goes to the preferred equity position before the common equity position, okay? Now here's kind of the confusing thing, all right? A limited partner can sit in both a preferred position and a common equity position, okay? So we're gonna just take a brief second to cover the capital stack again. Again, we've spent the last couple of weeks going into this in detail, but if the capital stack looks like this, we've got our debt, okay? They're in the lowest risk, highest priority position. If there's a second loan on the property, there's a mezzanine debt, okay? They take a little bit higher risk than the senior debt and a little bit lower priority. And then you got the preferred equity, okay? They're right behind any debt on the property, okay? But they get to participate in the upside of the property. Debt doesn't, okay? That is simply getting a coupon note payment back to the whoever originated the debt. Okay, they don't get to participate in the splits of the deal. Okay, now we have different stacks that we can look at, right? This one has this particular capital stack doesn't have a preferred position at all, rather than two different common equity classes. Or you can have a dual tier stack where you actually have a preferred equity class, a common equity class, okay? Even in the single tier stack, the common equity class might have a preferred return in it, okay? It doesn't mean that it doesn't, but it can. So it's really important that you understand how to read the documents in order to figure this out. Now, how do you find the preferred return? Okay, the preferred return oftentimes is listed in the executive summary on a deal, okay? But not always, okay? I have seen, probably in the past year, a lot of operators start pulling that preferred return out of the executive summary, especially if they have a dual tier stack, something like this, where there's a class A, a class B, and then the class C is the general partnership, okay? They don't want people getting confused, all right? If you can't find it in the executive summary, oftentimes the next best place you're going to find it is in the financial section of the document, okay? And this is a section that I encourage you as a limited partner to get very, very, very comfortable at reading, okay? And understand how the preferred return is working and how the capital stack is working, okay? If you don't see a preferred return, don't assume there is one. Make sure you ask the general partner if there is a preferred return, especially if that's what you're looking for investment, okay? Not all deals have a preferred return. We put a preferred return in our deal because we very much stand behind that. It creates an alignment for the investor, right? You have traded your time for dollars, and you are putting your hard-earned dollars to work in an investment that we're running, okay? We feel that that's one of the best ways to create alignment with you, okay? Now, how does the preferred return actually work, okay? Especially if the preferred return is suspended, okay? Now, let me just take a second to recap a couple of the risk of any real estate deal, whether it's your own single family rental that you have next door, or if you're invested into a large multi-million-dollar project. The preferred return, the risk of the deal is that your capital is at risk, okay? There is potential loss of capital, all right? Now, you yourself, if you're the operator, you're going to ensure that you have reserves set aside to ensure that doesn't happen. You're going to manage the project in such a way that you don't lose that capital. We do the exact same thing, okay? The other thing is, another real risk is that distributions are suspended, okay? Well, that just means if you have your own single family property that your tenant didn't pay rent that month. Maybe you had a vacancy, or you had a super large expense and you needed the rent to cover the large expense rather than giving yourself a distribution, okay? Same thing applies here. Now, in the case of working with a syndicator, okay, if you're running your own single family property, you make that up with future cash flow, right? You will make that up on the back end. Same thing here. With the larger deal, with investing in an operation with us, we do a preferred return. We make it cumulative. Okay, so if we say the preferred return is 7% on a deal, and the worst case scenario happens, and we have to suspend the distribution for a month or two on a project, that then becomes cumulative. We can pay it out with future cash flow at a capital event, or even at the sale of the asset. Okay. You want to understand with any operator that you invest in if the preferred return is cumulative. Okay, not all the time is it. Sometimes the preferred return, if it gets missed, the operator, depending on how they have it outlined in their PPM, could just not pay that distribution to the investors. That's not very good alignment, but you want to understand if the preferred return is cumulative, meaning that is as close as you can get to guaranteed money to you. Where will you find that? It needs to be outlined not only in the offering memorandum, okay, I would like to see it there, definitely, absolutely must be outlined specifically in the PPM. The PPM is the legal document that drives the entire legality of the deal, okay? So make sure that you're combing through the PPM to understand the, what is the preferred return? What is the capital stack? And what happens to that preferred return or the distributions get suspended? When is the preferred return made up, okay? Again, as I mentioned, in general, especially with us, when you invest with us, it's made up with cash flow, the next capital event, such as a refi or supplemental loan, or on the sale of the asset. Okay. Now let's practice. Okay. We're going to take some of our, our learnings from the past couple of weeks, especially if you've been on and we've been working through the capital stack. Here's just a little example of something that I pulled out of a deal that we did last year. You guys, I would love for you to tell me, what is the preferred return on this deal? Jump over to the chat box, let me know. All right, anybody got an answer here? Okay, 9%, 9%, okay, a couple 9%. All right. 9 or 7, yay, yep. The preferred return here can be 9 or 7, okay? So let's talk about why that is. We've got two different classes of investment here, okay? Remember, let's go back to our stack. This box right here is actually what we call a dual tier capital stack, okay? We've got our senior debt, and then we have a preferred equity class that's only earning a 9% preferred return, okay? So the distribution of cash flow, they're getting 9% preferred return to the investor. As far as membership ownership, they're getting 9%. So meaning they only get their 9%, that's it. All right, now their class A, they more than likely in that PPM, they're gonna be structured right behind the senior debt. They're gonna take a lower risk, higher priority position in the capital stack. However, they don't participate in any of the upside on the deal. Okay, they're not participating in any of the supplementary returns or refinances. Their chances of getting capital back early, the capital is generally locked in for the duration of the deal until the deal sells. Okay, and when the deal sells, they're not going to get a capital gain. All right, now they're trading that for a better position, potentially better position in the capital stack, and for a higher preferred return. Class B investor, their position in the capital stack is right behind the preferred equity class. Okay, so this class B, they're still ahead of the general partnership. Okay, and their preferred return is 7% on distributable cash flow, and then split 70-30 thereafter. And then on the capital gains, it's 70% to 13% IRR, and then 50-50 thereafter. So when we're looking at the preferred return, there are two preferred returns. So it's very important to understand what class you're investing in. I've had investors that, have made mistakes in their investment with previous investments, and they invested in a preferred equity class, and they're like, I can't wait to get my capital gain. What am I going to do? And you're like, oh, you don't. If it's a preferred equity class, more than likely you're not going to have a capital gain. It depends on what that PPM says. All right, so good job, guys. All right, now here's another. This is looking at same deal. Okay, this is looking at the financials of the deal. Okay, this particular deal went out to 7 years. My question to you is, let's go down to invest the class B. Okay, class A, they get 9% monthly cash flow across 7 years. Okay, now class B, I want you to tell me what the return is in year 1. All right, 4.4. Okay, yay. Okay, now that's 2.6% below the stated preferred return as 7%, right? Class B, 7% preferred return to investors, okay? Year one, the first calendar year of ownership is 4.4. Based on what we covered earlier, what happens to that extra 2.6%? Okay. It's carried over. Yep. Okay. So it can be carried over to paid out in future cash flow, at a refinance or a supplemental loan, or at the sale of the asset. Okay. And this is another kind of sticking point with investors, especially, last year, with COVID, we're still doing very stringent underwriting on our deals, and, eviction moratoriums, are they in or out? Right now they're out. But we've been really going into the year one, year two on our deals with underwriting very conservatively on them. And sometimes you will see that there's a spread depending on what the business plan is. This particular asset was a Class A asset. So totally tenanted. And so we needed a couple years or a year or two to start turning leases and bump up the return on the asset. Okay. So this is another sticking point. If you just stopped here, you would be expecting a 7% preferred return paid out annualized monthly. Okay. And 7% annualized return paid out monthly. But here you might get a little bit of a shock if you didn't go into the financials and really understand what is happening year over year. Okay. So guys, that's really what I wanted to cover today. And I really thank you for taking the opportunity for allowing me to help guide you through this information. If you guys have any questions, jump over the chat box. I would love to field as many questions we have in the next few minutes. And while you're doing that, if you want to sneak peek at any of our deal flow, jump over to goodegginvestments.com/invest. Take a quick minute to fill out the quick application there. That is where we get to understand, who you are, your investing goals, and then we can follow the next steps and maybe hop on a call from there. And this club is for anybody, whether you're just starting out investing, doing this on the side or have never done a deal yet, or you're a pro, you're doing this more full time and you want access to even more deals, jump on over to the Goodegg Investor Club. And for those of you who need to bug out right now, I thank you for spending your most valuable resource, which is your time with me. Here's my contact information. You can jot that down real fast. And, let's jump over to the chat box and answer any questions.